Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right, welcome to Pilot Money Guys. I'm your host, Charlie Mattingly, along with co-host and superstar Chief Investment Officer of Leading Edge Financial Planning, Andy Christopher. Andy, welcome aboard, and we're glad to have you back.
Good to be here. Another quarter in the books.
That's right, man. I can't wait today to talk about all the stuff you've got on the docket for us. We're going to talk about some stock market history, some IPOs. One that just a small little IPO that just happened. You may have heard about it. I don't know, SpaceX, something like that.
Teeny tiny.
And we're going to talk about just what's going on in the markets, especially Q2. We'll mix that in with some historical context. A little bit of everyone's favorite inflation talk, Fed talk. Mm-hmm. We're going to talk about, why may or may not lower or raise interest rates. What are the pros and cons, and some things, again, fight through the noise there, like we talk about, because often we hear, Andy, about what's going on.
Yeah.
And it's just, I'll just be honest with you, I just think it's wrong. I'm like, that's just wrong. That doesn't even make sense. But anyway, It's hard to, I should say, it's easy to have misunderstand some of the information that's out there. So our mission today is to cut through that noise, try to simplify these complex issues, and just help our listeners, our pilot tribe, build a mindset for financial life success. That's our mission at Pilot Money Guys, Andy, and at Leading Edge Financial Planning. So, if anybody wants to contact us anytime, reach out to us, Andrew at leadingedgeplanning.com or Charlie at leadingedgeplanning.com. We'd love to hear from you. If you're listening today, you want to get an idea if you're on track for retirement, thinking about the right things, check out the Pilot Wealth Index wherever you're getting your podcast. Go there. There should be a link that says the Pilot Wealth Index. Just answer the questions. It kind of, we designed that, Andy, so that people know, hey, are we thinking about the right things? Are there some things that we're just plain old missing out on things that we don't know about? So check that out. We'll see that. We'll give you some feedback. Just give us a call if you have any questions as well. And we always appreciate it when you rate and review the podcast. Share it with some folks that you think might find it useful as well. We'd love to be able to reach as many people as possible and share the message. So, Andy, you're a bachelor right now. I think you said family's out and about. What do you do when you're a bachelor? What are the things that you like to do, like maybe you couldn't do otherwise? Man, you hit the bottle. What do you do?
Yeah, you just. I thought you were gonna say go hit some balls, like go golf.
No, I mean, you climb into the bottle, like I can do this. I'm kidding. I go eat cheeseburgers. Like that's
a good idea. Yeah. I eat like a bachelor, and just like it's sad. My dinners are sad. Makes me
You just leave
tuna melts out of the can,
That's right. Leave the dishes in the sink just out of spite. Like, I'm doing this.
Yeah, right. Yeah.
Oh, that's awesome. All right. Well, very cool. Well, good, man. Well, it's good to have you on board today. Hey, first, before we get into our main mission of talking about markets, et cetera, I want to put a plug in for Emily. She's our business development guru at Leading Edge. Emily Rendell, you've heard her on the podcast before. She's set up our website, our YouTube page. And basically, we've got lots of content out there. So go to the leadingedgeplanning.com website, click on who we serve. There's going to be almost every airline there, and we're going to have content for each one of those. So recently, you and Kevin, the professor, Gormley, put out some FedEx retro pay details on the new contract. Congratulations, FedEx pilots, on the 40% raise and all the other good options that are in there. Yeah, some really good stuff. We've got one, me and Nolan did one on saving more on disability if you're a Southwest pilot than you did when you were flying. So it's pretty incredible, the opportunities there. We don't want people to be on disability. Let's just put that out there. But if you are, there are some things you need to think about there. So check that out. Go to YouTube and just Google or type in, I should say, Leading Edge Planning, YouTube, Southwest pilots, FedEx pilots, Delta, United, American, even NetJets, executive jet management. We've got them covered.
Yeah.
All right, Andy. Anything on your end? What are your initial thoughts before we jump in today? Anything on your mind?
No, the FedEx is a good one. Kevin and I enjoyed doing that video. A lot to think about there. Bonuses are great. Like we said, that's not a gift from FedEx. That's hard-earned money that those pilots, deserve. So, but things to think about: number one, taxes, and then just kind of the list of like, all right, I just got this windfall. What do I do? So that's always a good thing to think about, because it's once in a lifetime type of cash probably that's coming your way. So
and cool. Reach out to us. A lot of pilots reach out to us, Andy, and they say, "Hey, look, we got a great opportunity. We don't want to squander this. We don't want to let it go by without taking advantage." So we're here to help. If anybody wants to give us a call, email, whatever. But Andy, true or false? FedEx retro pay taxed at 22%.
That's what I'm hearing. Yeah, that's what we hear, which is
that's trouble. That's trouble waiting to happen.
If you're a high earning captain and you're in the 32, probably 35 or higher, you might be under withholding. If you're a FO, you might be okay because it's your effective tax rate is probably right around there anyways. But they kind of had two paths to go. And we saw this with Southwest a few years ago. Southwest, I think, did the opposite, and they withheld at kind of like just normal W-2 type withholding. Yeah. So you just, I think it's going to be a flat 22% for our FedEx folks. So just something to think about there. And number one is you don't want to get surprised in April on the tax side of the house.
Absolutely. Yeah. Well, I think that's as we say in the pilot training world, that's a foot stomper, because both of them are going to hurt a little bit, but I think I might want to get the hurt over with sooner than later, because you kind of forget about it. You go on with your life, you spend a bunch of money, and you enjoy the retro bonus that like you said, you worked hard for. And then next thing you know, a nasty tax surprise comes your way in March, April timeframe. So just be cautious, be ready, and we'll keep our eyes out for that one too. Awesome. All right, Andy. Well, thanks for that. Let's see. As far as the quarterly market update, let's jump in. We're gonna focus on the quarter, but we're also going to talk about a little bit of broader context on some things that are interesting as well. But initial thoughts from you on the quarterly market update. What do you got?
Yeah, it was kind of an interesting quarter. It was great. That's kind of initial thoughts is, best quarter in 6 years, at least for the U.S. Russell 3000. We celebrated, at the very start of this quarter, so not last quarter, our 250th anniversary. So we brought that in with a bang, which was cool. But kind of an interesting quarter for sure. There's some AI trades, small cap. We'll jump into it. So kind of a rotation out of like S&P 500, just U.S. large, into more, I'd say, like breadth in the market, which I think is a good thing overall when we look at just sort of concentration within the U.S. market.
Yeah, that is fascinating. I don't want to derail, the show and the outline here, but it is fascinating. This is like the first time where, at least year to date anyway, maybe not second quarter, that although the S&P is doing well, there are other asset classes that are doing really well, and we'll talk to those soon.
Yes, absolutely.
Yeah, absolutely. Yeah. But what do you think? Historical context, IPOs. What do you got on that?
We had SpaceX IPO in the quarter. So June 12th, SpaceX went live. They raised $75 million. $75 billion. And so that obviously the biggest IPO, in the history. I think Saudi Aramco was the one right behind that. So I think it makes it the 8th largest company in publicly traded company. So it's like you already jumped right into like top 10. Now, what that doesn't mean is that you're top 10 in terms of market capitalization from like an index standpoint, right? So you think of like NVIDIA makes up, probably 4 or 5% of like a Russell 3000 or the US broad market. I think we looked at like SpaceX. If you were to actually put it in the index, and it's trading in on the NASDAQ 100 now, they actually put it in just a few days ago. Maybe like very small percentage, less than 1% for sure, less than 0.5%. And that's because of the actual number of shares that are trading is what is used for index cap market cap weights. So that makes sense, right? They issued $75 billion worth of shares. Those are actually trading on the market today. Mm-hmm. But there's all these insiders, the founders, right? They've got stock and those are locked up for 6 months. So the actual number of shares that can exchange hands between Joe Schmoes like you and me is quite small relative to the, $1.7 trillion, value of that company. So that'll change. There's lockup periods. So people, usually it's 6 months, will be able to sell those shares who are insiders. So in other words, employees. It'll be interesting to see what happens when that transpires, right? And kind of what the market does. But it had a pop for sure. It was up 22, 23 the first day. And it's been pretty muted since. And that's kind of what I think the historical data suggests in terms of how an IPO typically performs. They generally have nice big pops on day one, kind of by design. And then they're sort of muted relative to the market over, 1, 3, 5 years. So there's a professor, Jay Ritter, he's at the University of Florida. It's like nobody knew his name. And then all of a sudden he was like on CNBC every day. He was on Bloomberg, right? It was like when SpaceX. So he got famous quick because he's like the IPO guru, right? Down in UF, down in Gainesville. But his data and his research, which goes way back, really does say like, IPOs. I just don't know that I want to be playing that game kind of right off the bat.
Yeah, and by muted, you mean like down? Is that what you mean?
Yeah, I was being polite.
No, you're using like Fed market speak or something. We got to pilot proof this thing, man.
Yeah.
So basically, I mean, it's not down a ton. I guess that first day it was crazy. First day or two.
First 3-4 days it was trading.
Yeah. So it's Andy, it's fascinating to me because there's a lot of really smart people out there. And I bet it seems like about half of them have complete faith in Elon Musk and the magnificent, things that are going to happen. And then there's the other half that said this is going to be a loser and they'll all be bankrupt. All the stuff will be bankrupt in a year. You know what I mean? So it's you got some really smart people saying both things. And so my takeaway from that is that this and other IPOs, along with other investment strategies that we've talked about before, are you just got to put them in the category of complete, pure speculation. Yeah. It's a coin flip. We don't really know what's going to happen here. And if we pretend like we're going to know because it's Elon Musk, I think that's when we get in trouble.
Yeah.
So, you know what I mean?
And by the way, that's not like IPO specific. That's just individual stock specific. Yeah. And we probably should just kind of shout out to when we had Hank Bettenbinder. Yeah, he was on. It's like, what drives people's market returns are very small subset of the market. So individual stocks by design, sort of like a large percentage actually underperform just T-bills, right? And so like IPOs they're no special or no different from just that kind of mentality and construct of like, it's, the winners are going to be the what are really kind of like pulling the rest of the market uphill, to build the pyramid of wealth, if you will.
Absolutely. Yeah. Well, awesome. Yeah. That was fascinating time. And, it elicits a lot of emotions when all this excitement's going on. And I think that's where as a disciplined investor, you just got to be aware that there's a lot of hype going on here. And let's look at the data from Jay Ritter, the smartest people in the world on these things and just kind of, be disciplined with our decision making there. But Andy, moving on to the U.S. equities, like I stated before, I think it's fascinating to finally see like the rest of the world, diversification, if you will, kind of paying off. So it's kind of been interesting. I haven't seen that in a while.
Yeah, we're looking at the screen now for our YouTube viewers. The U.S. stock market up 15.4%. For the quarter,
that's incredible.
Dang, and that's the best since the second quarter of 2020. We all know what was going on in Q2 2020. So that's just this one kind of caught me off guard a little bit. I was like, I didn't know she had it in her. Like,
no, what the heck is going on here?
Yeah, maybe I'm getting consumer sentimented as well, and we'll talk a little bit about that here in a few slides. But I think your point of like what's going on just even in the U.S. market, across, right, like large caps were up 15.14% for the quarter, but small caps in particular small growth up 25 percent, just small value up 17%. And so what I think is kind of cool here is, right, we've talked about the Mag 7, these AI hyperscalers, concentration in the market, seeing some rotation out of large cap into some of these other parts of the market, on net is a good thing. And if we even look kind of like just market wide, so again, 15.4 for the quarter, trailing 1 year, 22%. But some of these big numbers, small growth up 38% for the year, just small cap 43% for, the trailing 1 year. But here's the point, Charlie, is you got to own that, right? And so I think about a lot of people who are just in S&P 500 index fund, like you don't really participate in that. And it's done, S&P 500 has done great, but just to your point of like, even within the US, diversification is super, super important to own just more than some of those bigger companies.
Andy, what I think is fascinating, I mean, these numbers are huge. And so, which is great, but I think it's almost a return to normalcy because 2020, 21, 22, whatever, even maybe since 2008, if you really want to go back far enough, the US S&P has just been dominant. Yeah. And after a while, people are like, why are you investing in anything else? What are you, stupid or something? And you're like, well, diversification, we got to have discipline. And, now this is the way it's supposed to be, where you got other asset classes doing something. And again, this is a little abnormal because it's so high in one quarter, but nonetheless, to me, it's almost like we're returning to a little bit of normalcy because a couple of those years were like, oh, wow. This divergence between large growth and let's say large value is weird, So you just get some of these that you kind of know they're overvalued, but you don't know how long it could go on for. And the opposite, Andy, it seems like the large value was underperforming so long. You're like, how long is that going to go on for? So anyway, bloviating a bit here, but it's good to see this.
Yep. Yeah. And then, kind of like we alluded to, outside of the US, that still did great. Developed market, 10% for the quarter. Emerging markets, we're going to talk a little bit more about that, up 24% for the quarter. So that's pretty impressive. You can see that's, last time we were kind of there was 2009, 34%. So just big numbers last quarter, really, really big numbers. And it's kind of like you and I were talking before, Charlie, is like, man, what's really driving this? We had kind of a muted quarter last quarter. But it's just really interesting to see kind of this came out, I think the big drivers, right? Like Iran, war, we're sort of kind of have to like, pause your brain June 30th, because of course that's an evolving situation. Today, right, as we speak, but that idea of the Strait of Hormuz, more goods flowing through that. Hiring was a little bit more, I'd say, muted, and that was kind of a good thing. Of like because if you start seeing big inflation, right, especially oil, fuel, food, right, things that are going to be heavily impacted by a large scale conflict in the Middle East. And lots of hiring. That's like, and we'll talk about this a little later. It's like feds. That's like, like we might have a problem brewing here. And so it's kind of like, have we sort of, the markets are like maybe Goldilocks it a little bit of like, we still have growth. The goods are flowing and growth and hiring, but not too much. So we're kind of like, the market's doing pretty good. It's just kind of fascinating.
Andy, what do you think about how the markets, we know they're a leading indicator. And so it seems like to me that we get some news like, oh, we've got a ceasefire in Iran. Now I know as we're talking today, I think one day we have a ceasefire and one day we don't. So I don't know what's going on, quite frankly, today.
Yeah.
But nonetheless, it seems like the markets go, oh, this thing's over. We're on to bigger and better things, so to speak. And in other words, the win, if you want to call it that, in the Middle East or Iran gets priced into the markets. It seems like, and what if that's true, comment on that. But secondly, if that's true, then I kind of am a little bit cautious about, when it doesn't go as well as we might think it is. Maybe the market corrects. I'm not trying to predict that. I shouldn't even say that. But nonetheless, I think when the market prices in information that's, that may or may not be true for the long term, that's where I get a little cautious. But any thoughts there?
No, I think that's right. If you look at, we'll continue to use the Strait of Hormuz. Oil was over $100 a barrel and then went down to, I think 70, right? So of course the market will look at that and say, well, if this company, right, is, airlines are a great example, right? Was otherwise paying, higher fuel prices and now it's lower. Like, well, that means higher profitability, all else being equal. So that would command a higher share price. And that's just, those are the things I do caution against, trying to isolate the market to one reason, because it's really tempting heuristically to say like it's this one thing, but it's hundreds and thousands and millions of things that are causing the market to move in any one day.
Yeah, you're exactly right. In fact, what I just said there was probably a really good example of the isolating the market. Trying to go, if this is true, then this must happen. One thing, one for one, when you nailed it. It's like you and I talked about beforehand. It seems like businesses are making money right now. And that's really, in the long run, that's really where stock market returns come from, is corporate profits. And so, man, it's really a fascinating time, and trying to get your brain wrapped around, because I think initially the sentiment, if you will, is like, man, we got a war going on here. This stuff's going on, but yet the market's going up. So it's a little confusing, but I think you nailed it. There's a lot of other factors going on there that are at play in addition to that.
Yeah. Yeah. I think some of that's like the AI, how profitable are these companies going to be? And it was just in the Wall Street Journal, maybe a few days ago, was companies are really, maybe it wasn't the Wall Street or Bloomberg Business, but companies are trying to look at like, we're spending a lot of money to have this Claude 5 point whatever do this thing, and they're sort of like, well, are we actually getting anything out of this? And they're actually telling their people like, hey, you can't just AI everything. You got to be selective. We pay a lot of money for this AI, and so these AI companies, they're making lots of money because companies are paying for it. But I think at some point, we'll start to be more selective in terms of where we use AI in the workplace. And we use it, even at leading edge to some extent. So it's kind of fascinating just to see how that's playing out across the broader economy. And that's really what a lot of this is being driven by, is like, okay, like AI spend, data centers, all this free cash flow going into CapEx on these companies. Are they going to turn that into profit? Because that's what I care about as a shareholder and an owner of these companies. Is this going to actually translate? And so that's when we see these gyrations, it's because it's kind of a question mark. Yeah. Right. We're still kind of in the unknown on just what's this going to look like?
Yeah, absolutely. It kind of reminds me, and what I hear you saying, Andy, too, just kind of to try to restate that, it's like what it feels like is money has just flowed into, all the money has flowed into AI. Just put your money in AI, put it in. But now we gotta see if this is really going to play out. And it probably will, but it just might be different than we expect. It might take longer than we expect. And so maybe there's a little bit of an overshoot that we might see. It kind of reminds me of an IPO, maybe, where all this money and hype comes in, and then we kind of settle into reality, and we don't really know what that's going to be like yet. So that'll be fascinating to see how it plays out.
Yeah. Exactly. Right. I think, one of the things we were talking about, Charlie, before, was like, are we just sort of sad?
I don't know.
Like the market just had its best core. Yeah. Am I just sort of sad? And what was super interesting, right, is like um, this University of Michigan, they do this consumer sentiment survey. So in other words, they go out, they ask, and they've got their statistical analysis to say like, how does the consumer feel today, right? And it's interesting. It's like we're kind of like as low as we've been, So that the long term average is 83. That on a kind of a scaled number there. So 83. We're at 53. We're kind of the lowest in our 50 years since the 60s, essentially. So
that's incredible.
Yeah, it's just kind of funny, right? Because it's like we just talked about how the market is just going crazy.
Yeah.
And yet we're just, as consumers, we're kind of in a malaise, if you will.
Yeah.
I don't really know what to make of that. It really kind of is interesting. It's interesting to me. What do you think?
Yeah. So I'm wondering like if this is kind of that Goldilocks you're talking about where people are not exuberant and irrational in the markets. It seems like I'm guessing there a little bit because the sentiment is down. And so, but people are spending money. Corporations are making profits.
Yeah.
And so sometimes I think that's hard to see because of all the noise out there a little bit. So anyway, I'm just trying to make sense as well of my perspective. And it's incredible because I think we're also, there's a lot of noise out there and it's confusion. Even I'll speak for myself on inflation. Like inflation is probably not as low as we'd like it to be.
Yeah.
But we're talking about lowering rates and we've got higher energy prices. And so I think there's a lot. Again, talking about myself here, there's a lot of confusion or just different data points that can be noisy, feels like.
Yes. Yeah. I totally agree. I mean, I think, I think we're in a place where these companies are, again, companies are profitable, but the market's just, we're just not happy.
I know. And I made that confession hoping that you would like immediately clear it up and make sense of it, but not going to happen.
Yeah, I don't think so. I will share this. What's interesting is that this has happened before. You can see in the 2000s, right? Sometimes we think about that as like the .com era, right?
Yeah.
I'll waste time spelling .com.
There you go. Nice job. Yeah.
Did it.
Mm-hmm.
So you can see, that was when we were at our highest. And a lot of times people compare this, like the age of the internet to today's the age of AI. But we were like, man, everyone was just cranking.
That's where the irrational exuberance term came from, right? That's the very moment, I think.
Yeah. Late Alan Greenspan just passed away, a week or so ago. He called it. Of course, he called it kind of like 1995 time frame. So that's a good reminder too, right? Of like irrational exuberance. But we're down here, this is. We're not going to trade on this, but it's kind of funny just to look at like, hey, and all of these times where sentiment's been really low, like look at the market in the next 12 months, right? 2003, we were pretty low, up 32, 08, up 22, 2011, 15. So does that mean the market's on its way up? Just who can say?
So you're making a prediction? Is that what you said?
Making a prediction. Calling it right now.
Let me, I'm going to add some of the color to this for people that are listening, because what you're sharing, and by the way, go to YouTube, check it out. But in January of 2000, I think that's probably the end of the tech bubble.
Yep.
Sentiment was very high, the highest in, 50 years, whatever this chart is. And then the stock market subsequently was pretty bad for a while. I remember that as a brand new investor. I was like, I hate the S&P 500 and it sucks. But anyway, and back in 1980, it was very low, similar to what it is right now. But the market, 20% subsequent returns, I think the next year maybe. But so again, not a predictive kind of thing, but it is fascinating at this where we're at. in relation to the sentiment and the stock market returns.
Mm-hmm. Mm-hmm. Yeah. Yeah. Super fascinating.
Yeah. All right, Andy, what about, let me ask you this real quick and then we'll move on. I just can't resist. The idea that we kind of, I'll say we, in air quotes, we kind of want the Fed to lower rates. You know, it makes us feel better in the stock market maybe. But what are your thoughts on that? Pros and cons? We could talk the whole time. In fact, I think the next podcast or two, we need to do interest rates, Fed, inflation and Fed. We need to revisit that. But give me a 30-second, snapshot on interest rate lowering, raising. What happens?
Yep. Yeah. So I think in general, right. So there's a committee, the Federal Open Market Committee. They're 12 officials at the Federal Reserve. So 7 governors and 5 bank presidents. Shout out to the Cleveland Federal Reserve. They're on there now. It's my hometown. So they vote, right? So number one is we have a new Fed chair, Kevin Warsh. So he was sworn in, replaced Jerome Powell. That was high drama. He's technically he's a governor as well. And so there's lots of talk of the Fed was now going to lower rates because Kevin Warsh. Well, he's the Fed chair. He's still one vote of the 12 of the FOMC. So those governors are political appointees, and the bank presidents. There's a board of directors for every regional bank, and so they're the ones setting interest rate policy. If you remember, the Federal Reserve has 2 mandates. Inflation, they target 2%. So we were at 3.3, 3.8. On the last print for PCE, as well as maximum employment. So those are kind of their the two mandates. And so to the extent that the Federal Reserve is going to raise interest rates, that would really be if they think inflation is going higher, or if unemployment is going, I guess employment is lower, which is kind of like wage inflation, if you will. So interestingly, right, Kevin Warsh, lots of discussion in Senate confirmation. How independent was he going to be? The president, of course, is like every single president wants lower rates. That's not new to this president. In fact, George Bush in '92, really I think kind of blamed Alan Greenspan, right, even of kind of like torpedoing him when he lost to Bill Clinton. So that's not a new paradigm that the president wants lower rates, but Kevin Warsh in his first conference, I think, sort of reinforced Federal Reserve independence. In other words, he said, "Hey, we're concerned about inflation. We still have a mandate to target 2%. We're going to do things to make sure we have inflation under control." So we reinforced the idea of an independent Fed, which I think is really important. I mean, the Fed is kind of a boogeyman, and it's opaque even in the best of times in terms of what they do and the power that they have. But, an independent Fed truly is, I think, one of hallmarks of a stable, strong economy. And I think they reinforce that. So to the idea that, like, hey, interest rates, we want to lower them. I think one of the most important things is when it comes to inflation, it's not just inflation, it's how people think about inflation and how they think about what is the Fed going to do about it. And so I think the way I think about that is it actually lets the Fed do things without having to do things, which is kind of a dumb thing to say. Sounds silly, but if people think the Fed's going to do it, then it means they're going to price that into their expectations. And so again, that's, if we don't think the Fed's independent, then people will stop thinking the Fed's going to do things. And then that's where we start to see more inflation.
Yeah. I think, and by the way, we interviewed, Federal Reserve. I think she was maybe public relations. I don't know her exact title, but it was fascinating. Flight 88. Check it out. I enjoyed that interview. And I think she did an amazing job of talking about why the Fed is motivated to stay independent, kind of like the military, Andy, is what it reminded me of. You have a mission and that's what it's all about. But Flight 42, check that out as well, about the Fed. And that was back in 2022, which was a down market year. So check those 2 out that we have.
Good one.
But I think, we don't want to, again, we'll do a whole nother one because they're fascinating, but inflation, the Fed, et cetera. But I think the one thing that makes me nervous is that if the Fed were to lower rates now, that's going to increase economic activity. That's the whole point, which would potentially increase inflation. I think, is that safe to say, Andy? Do I got that right? Kind of.
Yeah, and
oversimplification.
You never know.
Yeah,
it's I think one of the ideas is, and kind of back to Alan Greenspan, 2000, he was looking at it and saying, there's something else going on. This internet thing is something's happening, and it's productivity. And so if you have higher productivity, you can actually have lower rates. Was kind of the implication. And so I think that same conversation is happening now. Is AI substantially increasing our productivity? And does that mean, right, like all the spend and everything happening, like does that change the paradigm on what our R-star is, right? For what is that neutral inflation rate that allows the economy to continue to grow without kind of spiraling out of control.
Yeah, it's fascinating. Then, the inflation, if we have high inflation, I think sometimes we underestimate how bad that can be, because it can be a permanent destroyer of wealth if we have persistent high inflation. Whereas a stock market decline, if you stay put and, be disciplined, it's usually a temporary thing.
Yeah.
And so I think those are the things that we sometimes forget. Inflation is like an invisible wealth killer. And so we got to, I think it's a big deal and one easily overlooked.
Yeah.
But more on the next one. That's a fascinating topic. But Andy, international emerging markets have killed it. And what are your thoughts there as far as the latest on that? It's nice to see international show up to the party.
Yeah,
they've not been bad, but boy, it's been lagged behind for several years.
Yeah, they're partying for sure. We're looking at emerging markets right now. So you up the quarter, just market wide, 22.7%, which is pretty incredible. And then emerging market growth up 26.5%. So outperformed the U.S. on the emerging market side of the house. So what's interesting is when you think about what was the driver of this, I think it really is, it's kind of an AI play. And so if we look at the global equity, just market concentration, and we look at, we've talked a lot about the U.S., right? I think 38% in the top 10 companies, right? NVIDIA making up, just over 5% of that. But emerging markets, it's 41% in these top 10 companies. And then you can see even like 19% of that index is Taiwan Semiconductors. Another, probably close to 10% or so is Samsung. SK Hynix, it's actually trading in the US as an ADR starting this week. So kind of like 3 companies making up that are kind of AI, hyperscaler, memory, kind of making up that 30%. So super volatile, right? And if you follow like the South Korean stock index, like there's some swings in that index. If you watch that thing, like it gets wild for kind of like as you would expect. So it's just kind of fascinating to think about what's going on in emerging markets, because we sort of think about that as these sort of ho-hum companies and lower growth type countries, but it's kind of this AI play here. But it's good to have. We want to have it in the portfolio so we can capture it. But just I would say certainly a little bit more volatile than even just U.S. equities.
Yeah. Andy, I like what you said earlier. I mean, all this is interesting to see what's going on. You and I are fascinated by it. Even if you're not interested or fascinated like we are, the point is that diversification, it makes sense. It pays off. It's not just an old boring thing to do. It's actually a winning strategy in the long term. And I think one of the feelings that we get as investors when, let's say, emerging markets goes on a 10-year hiatus and it just doesn't do anything.
Yeah.
And you're sitting by with your emerging market placeholder in your investments and you own it and you're buying it and you're like, man, I'm missing out on better returns. I'm missing out every year because I own emerging markets. And I think that's a feeling that we all get when we own maybe small cap value. Like, hey, it's not performed well and we missed out on better returns. And so maybe you can comment to that, but to me, it feels like intuitively that I don't miss out because I'm buying it, at a lower price as it's not performing well, and not every asset class will perform well every year. But what are your thoughts on that kind of a natural, logical feeling that we get when the asset classes we own don't perform well?
Yeah, unfortunately, unless you own the highest performing asset class, you're always going to own an asset class that's underperforming. That's kind of like we talked about before. Like that's just the nature of diversification. Is you don't you're not concentrated in this highest performing asset class. So sure, I would have loved to have been in 100% emerging market last quarter. That would have been better for my portfolio net. But like it's just not a good investment strategy, right? And so it's sort of like I think about it like the baseline where you want to be is like the market weight. That's not lazy, right? That's trillions of dollars deciding where to allocate capital most efficiently. So that's sort of like diversification is, it's kind of just being where the collective minds of the economy think the highest, best use of that, marginal dollar in capital is. And so I think that's an important perspective, I think, for any investor when deciding on how to allocate is like, that's probably where you need to start. And that by design will sort of bias you towards global diversification. The U.S. is really only 62% of the total global stock market. So you'll get some just natural diversification just right there. And then to the extent that you want to bias yourself anywhere else, like just know that that's an active bet that you're taking against the grain a little bit.
Yeah. And I think too, I say this a lot, if, diversification tends to be like almost a cliche. Hey, you gotta be diversified, whatever. But it really, really prepares us as investors for unforeseen events, unpredictable events in the world. We don't know what's going to happen. Anything is possible, literally. And so we got to be prepared for multiple scenarios, whether the U.S. thriving or, like you said, being muted for a while, i.e. lost decades. So we've got to be prepared for those things. And this is the best strategy for that, I believe. But Andy, as we come up on our time today, we've got we've talked a little bit about the Fed, a lot of other market updates. We have not talked about fixed income, which is, one of my favorites for sure.
Why would you?
It's exciting, but nonetheless, what do you have as far as wrap up takeaways? What's on your mind there?
Yeah, I'll touch on the fixed income briefly. I mean, a lot of that is just tied into the Fed. The shorter end of the curve just did really well. So if you were short, I'll share this. That did better than like just the Bloomberg aggregate index. And for those who are watching, like the yield curve is just not inverted, but fairly flat. So you just don't get a lot of benefit from being out, 30 years versus the 1 to 3. So that certainly biases, more into the short end, short end of the curve. But the other place is if you think the market's super overvalued, like just take, the fixed income is not a bad place to be. It's not, it again, kind of to diversification to your portfolios. You can even diversify outside of the equities and into the fixed income So I think fixed income is more fascinating than equity markets, and more dollars trade, but I might be alone in that, that sentiment.
It's definitely, it feels to me more complex. There's a lot going on. It is fascinating. And by the way, if you want to learn more about the yield curve and the and the inverted curve or flat, call Andy. Email Andy at andrew@leadingedgeplanning.com. I'd love to have more of a discussion on that one because it can be complex, but it's fascinating because it tends to be this, like you said, it's a bigger market. So it's more voting going on to give us an indication of what people feel about the markets, or a sense of where we might be headed, or at least what people think was going to happen, right? I mean, that's kind of the upshot, I think. Yeah,
and I think it's actually a little bit more important. Like government officials don't really get worried about volatile equity markets. I mean, obviously if like Lehman collapses, that's a big deal,
Sure.
but like they start to panic when the fixed income market, like that's literally the plumbing of our economy is in the fixed income market. And so like, looking at like the yen, right? The yen depreciation, just this quarter, like those are things that get like policymakers' attention, the technocrats, if you will, attention, right? So it is important, but it's an important diversifier, I think, for just an investor.
Yeah, absolutely.
Charlie,
Andy,
before we wrap up,
remarks?
and I wanted, maybe this is going to go somewhere else, but I think this would be a good thing just to talk through in our, when we have our discussion on the AI hyperscalers and CapEx, right? And kind of back to that. So Eric, if you're listening, good luck. But kind of back to, we think about like this pricing in AI, how's this going to go? Like, just look at how much they're spending, right? So, CapEx expenditures have shot up. This is, Google, Amazon, Meta, Microsoft. I mean, just like literally it's a vertical line for those who aren't watching. And that what that means is free cash flow is the opposite, down vertical line. And yet these companies continue to they have profit, good profit margins. And they continue, the stock market continues to rise. But if this doesn't pan out, right, this is kind of what we were talking about, Charlie, is like, if this doesn't pan out, that's where we're going to see repricing. In other words, they can't turn this CapEx into profits or continued profits. That's going to be a big deal for investors. So I think just something to think about in terms of like, how is this being priced into the market? Clearly the market is saying we do think there's opportunity in AI and companies able to use this, but it's still a question mark, I think, for a lot of, at least my mind.
Yeah, absolutely. Yeah. And it's not like, by no means do we think bubble territory for the market, but maybe in a little small section where, like you said, if the AI doesn't play out or the profits don't show up like we think, it's still going to be a great thing. We know that, but the expectations are so high. Maybe sometimes they're not met initially. Yeah. But fascinating.
All right.
Back to the end. All right, Andy, any closing remarks and thoughts on your end for our listeners today as we proceed on with the second half of 2026?
Yep. I just think, this is the opportunity to look at your portfolio, right? The market had its best in 6 quarters. Discipline, rebalancing is what we're doing for our clients, right? Like, we're selling emerging market, we're selling US large. Again, relative to our targets, because I think it's just opportunities to go and like, let's take some chips off the table and keep the risk in place. So there's been drift. So I just think about this is time to rebalance, and just kind of lock in some of those gains, and just continue to be disciplined as an investor.
Yeah. I'll piggyback a little bit and just, be careful of the emotional highs from markets going up. It often lulls us to sleep and causes our expectations to change. And the next thing you know, the stock market punches us right in the face. And so be ready for that one.
Yeah, exactly.
A natural thing to happen in the markets and the economy. So we'll be ready for it. But Andy, thank you so much today for dropping some financial science on us. We appreciate it. We're better for it. So we hope all of our pilot tribe shares the podcast and rate, review, please. Again, we appreciate all the comments, feedback, good, bad, ugly. We appreciate it, and we hope it's valuable to you. Share it if it is. Let us know if it's not, and we'll do. We'll press on to the next one. But Andy, thanks so much, and we'll see you next time.
All righty.
Take care. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand We develop the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.